Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me at the market site in Times Square, we have Phil Mackintosh, chief economist at Nasdaq. We're going to discuss if there was too much priced in with recession risk. Phil, it's interesting. I came up to the studio and I looked behind me where all of our tickers are, and everything was green. And it was so nice to see. I almost did a double take there, but let's look at the first couple of charts here just to get a refresher of what happened in the past week. And was the sell-off overdone?
It sort of looks that way, right? So we can see the equity market has stabilized. We've actually a pretty good last week. And bonds as well went up to 3.1% on the 10-year yield, came back down. They're kind of stabilizing at 2.9. So the levels that we hit 2 weeks ago when everyone was panicking and all the screens are red, we've sort of stopped at those levels and come back a little bit on both sides. So the recession risk is coming out of the market a bit.
Do you think that too much risk was priced in?
It looks that way. If you look at even how equity markets sold off compared to bond markets, it definitely looks like the equity markets were thinking a recession was imminent and much worse than the bond markets were worried about.
And when we talk about inflation, and it has come in just a touch, kind of doesn't feel that way at the pump or the grocery store yet, though.
Yeah, so the good news is inflation, we've been saying for a while, it's meant to start coming down, and it is coming down. It doesn't matter whether you look at producer prices, import prices, the PCE, which is the way that I guess corporates say people are spending, or the CPI, which is the way we feel like we're spending. All those numbers are coming down, but you're 100% right. It feels when you go to the pump that the gas prices are going up and up, and they're actually at record highs, even though oil has come down since the war in Ukraine sort of caused the spike to $124. We're back down to 115. And so why is gas going up but oil going down? And it's all about refining.
Right.
So there's not enough refining capacity. Some have been taken offline. Some got taken offline during COVID by hurricanes, and they just haven't replaced them. So we probably will see prices keep going up through the summer, the driving season as well, unfortunately.
Let's talk about the retail investor. It was the story of 2020, 2021. Has the volatility in the market scared them away? I hope not, but...
Yeah, so what we saw ever since COVID with all the stimulus checks was retail wasn't just twice as active as normal, but they were net putting a lot of money to work every day. And so during the month of May, we've actually seen retail stop putting money to work, and we have had some definite negative sentiment, some net selling days. So retail looks like they're less confident about putting money to work, although they have still been buying ETFs really consistently, which is diversified, nice long-term investment.
Right.
But their levels of activity look pretty much the same. So retail's pretty active in the market still.
Do you think it has anything to do with inflation and higher prices? And we know what's happening in the housing market. Perhaps that discretionary money is one of the reasons why they're a little bit lighter with going to the market.
Yeah, I think it's probably more to do with the market coming down and
right.
Rethinking, stocks, I thought they always went up, but they don't. And this is, for a retail investor, like you've still got to think long term. We have pullbacks during rate rise environments. We have slightly bigger pullbacks if we have a recession. But if you look at the stock market over the much longer term, it does go up, it pays dividends. So don't panic and sell at the lows.
And we spoke about this last week. Just because there is a recession, it doesn't necessarily mean that the market is going to go down. In fact, recessions are part of the business cycle. It's a way for us to check the economy, if you will.
Yeah, and that's kind of why the Fed is raising rates to slow the market down. They don't want to cause a recession, but if you want to get inflation under control, you've got to stop us buying so much stuff when there's not enough stuff to sell. And
right.
so the Fed is trying to slow things down so that we buy less, so that prices start to come down as well, and then inflation's under control, because inflation has a whole lot of other distortive effects
right.
on people with bond income. And obviously, your wages at the moment might be going up, but not going up as fast as inflation, so you still can't buy as much.
Well, this could kind of be a crazy catalyst if we were to go into a recession and the Fed adopts a more dovish tone. That could be a catalyst perhaps to the upside for the market. It's just so weird how all these dynamics are in play.
It will be, and that's kind of when you see the rates. They got to 3.1%, now they're back at 2.9 on the 10-year. It's like that's the market saying, yeah, we don't think the rates are going to need to go quite as high as they were. Some of the data is looking a little bit more moderate, and so the risk that the Fed has to be really aggressive and cause a recession has that kind of dissipated a little bit.
All right, Phil, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq.